Hey everyone, in this video I'm going to compare AMD with C3.ai and answer which one I think is the better AI stock to buy now. So to make this comparison, I'm going to look at revenue, operating margin, cash flow, and valuation to determine which one is the better buy. So let's jump right in.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, we're going to start with revenue, but before we do that, let's look at the total addressable market opportunity for artificial intelligence. According to Statista, the total addressable market for artificial intelligence is expected to grow to $1.85 trillion by the year 2030. That would be up significantly from the $207.9 billion in 2023. Artificial intelligence is popularized by large language models like ChatGPT, but there are more applications like driverless car technology, recommender systems, and more. The companies that stand to benefit from the growth in this AI surge is companies like Amazon, Nvidia, Alphabet, Microsoft, and more. Investors getting in today could realize exponential returns from investments that capitalize on the growing effectiveness of artificial intelligence. So now that we have an idea of how massive this market could be, let's look at revenue for C3.ai and AMD. Of course, they're on big different scales here, with C3.ai at 284 million in revenue and AMD at 22.11 billion in revenue. But they've both done a good job growing revenue, and they've both got excellent prospects going forward. AMD working mostly on the hardware side of the equation, and C3.ai working mostly on the software side of the equation. AMD recently launched several new products aimed at increasing the effectiveness of its artificial intelligence capabilities. Meanwhile, C3.ai has a newer AI product in the market right now that it's testing with its customers. It first wants to show its customers the value of its AI services before it can really start to generate revenue from that newer service that it just recently launched a few months ago. So they both have solid prospects, and they both can grow for several years into that massive opportunity. The next thing I wanted to look at is their operating profit margin. And according to this metric, AMD has the better operating profit margin at negative 0.41%. However, AMD for a long time had done a good job generating operating profit margins in the double digits. While C3.ai has never generated operating profitability, it has been negative. Here's the zero marker here. C3.ai has always been negative, and it's only been getting worse. So its prospects for profitability are not that great right now. It looks like it needs to generate significantly more revenue to even approach profitability, while AMD, I wouldn't be surprised if it turns it back around and quickly jumps back up to these double-digit operating profit margins in the short while. So the next thing I wanted to look at is cash flow from operations to sales. And again, a similar trend in this metric, AMD doing a better job at 8.38%, but it had cash flow from operations to sales level closer to 30%. Again, while C3.ai has never even approached close to 0%, it has been consistently negative with little evidence in improving this prospects. This metric is important because it measures how much a company turns into cash its sales. So it determines how effective those sales are. Sometimes it's not worth making these sales if it's just going to cost your company more money, right? You're going to pay $130 to generate $100 in sales. Is that really worthwhile? Well, some companies think so because they think that even though they might lose money right now on the current deal, they think that they can upsell the customer, or they think that in time they can lower their own cost and eventually become profitable, generating revenue and profitability and cash flow. But for now, we haven't seen very much evidence of that from C3.ai. So that's in question right now. It yet hasn't proved its capabilities to generate profitability and cash flow from operations, which is a critical financial metric. All right, the next thing I wanted to look at is valuation, and I'm going to use the price to sales ratio. The price to sales ratio measures what you are getting for the price you are paying in terms of sales. So what are you getting for every dollar in sales that you're paying? For example, in this first example, the market capitalization is $1.25 billion, and the sales for the previous 12 months were $185 million. That means you're paying a price to sales of 6.76. Similarly, if you look at the expected next year revenue, you would be paying $1.25 billion for $465 million in revenue expected, and that would mean the forward price to sales ratio is 2.69. The factors that influence the price to sales ratio include profitability. Of course, you would be willing to pay a higher price for a company that generates higher profits. That means $100 in sales will turn into $20 in net income for a company that has a 20% net profit margin. That same $100 in sales will only turn into $5 in net income for a company that has a 5% net profit margin. So companies with higher net profit margins tend to sell for higher price to sales ratios, all else being equal. Another thing that influences the price to sales ratio are growth rate expectations. All else being equal, companies that are expected to grow at a faster rate sell for higher price to sales ratios. Similarly, higher total addressable market opportunities tend to result in higher price to sales ratio because investors see this company being able to grow for a longer period of time before hitting the ceiling. And finally, cyclicality. Companies that are more stable and less cyclical tend to sell for a higher price to sales ratio because cyclical companies are seen as being more risky. Companies like McDonald's are seen as being non-cyclical. McDonald's does relatively well whether the economy is booming or whether the economy is in recession. And so investors would be willing to pay higher price to sales ratios for companies that are less cyclical. Investors use the price to sales ratio when a company has negative earnings, unstable earnings that fluctuate between positive and negative, and also the same for cash flow. If a company has negative cash flow or cash flow that's fluctuating from positive to negative, the price to free cash flow and price to earnings ratio are less informative, so analysts use the price to sales ratio. All right, so now that you understand why the price to sales ratio is a valuable metric to use in comparing valuation, let's look at C3.ai and AMD on their forward price to sales ratio. And we could see they're selling similarly priced, with AMD at a forward price to sales of 8.462 and C3.ai at a forward price to sales of 7.906. So AMD is only slightly more expensive than C3.ai. But what we saw is that AMD was better than C3.ai in terms of operating profitability and in terms of cash flow from operations to sales, not to mention it's already at a much larger scale. So with all those advantages and only a slightly more expensive valuation, I would choose AMD as my preferred AI stock between these two right now. Thank you for watching this video. I truly appreciate it. I know there's a lot you could be doing with your time and a lot of other videos you could be watching. So I truly appreciate that you chose to watch this one. If you want to see more videos just like this, hit the subscribe or the like button. They'll both help me make more videos just like this one. Thank you again.